Hey everyone, and welcome back for another deep dive.
Yeah?
Today we're going to be talking about efficient capital markets.
Ooh, exciting.
It is exciting.
Big topic.
Huge topic. And to help us with this, we're going to be looking at a paper by Eugene Fama
Classic.
from 1970.
I mean, talk about a foundational paper.
Yeah.
Really set the stage for a lot of the way we think about markets today.
Yeah, so this paper is called Efficient Capital Markets, a review of theory and empirical work.
Catchy.
Yeah. So, we're going to be diving deep into this paper and really exploring, some of the questions we want to tackle are, can you actually make above average profits by just studying stock charts and, trying to predict future prices?
The age-old question
Yeah.
everybody wants to know.
Right.
Can you really beat the market?
Yeah. So we'll explore that.
Right.
We'll also talk about, how quickly do stock prices react to news, like when a company announces its earnings or if there's like a stock split, how quickly does that information get baked into the price?
Yeah, that's a good one because it really gets at the heart of how efficient are markets really at processing information.
Right. And then, of course, the big one, do insiders like corporate executives or, specialists on the stock exchange, do they have an unfair advantage?
Right, because they're the ones with the inside scoop.
Yeah, exactly. So we'll explore all of these questions. And most importantly, what does this all mean for you as an investor?
That's right, because at the end of the day, we all want to know how to make better investment decisions.
Exactly. So
All right, so let's jump into it.
let's jump into it.
So tell me, what is an efficient capital market?
Well, this paper, it kind of throws out this idea that security prices fully reflect all available information.
Okay, so what does that actually mean, though?
So that means that at any given time, like a stock's price represents the best collective judgment of the market about its true worth.
Okay.
Like given everything that's known about it.
So it's not just random, there's like a logic behind it.
Exactly. And this seems like a very simple concept, right?
Yeah, on the surface it does.
Yeah. Yeah. But it has huge implications for how we even understand how markets work.
Absolutely, it changes the whole game.
Yeah. And how we invest.
So how do we even know if markets are efficient?
Well, the paper talks about, like we said, different forms of market efficiency.
Okay.
It mentions weak form, semi-strong form, and strong form.
Right. And those refer to what kind of information is reflected in prices.
Yeah, exactly. So are we saying that markets are perfect?
Not necessarily. I think the paper really focuses on this idea of a fair game model.
Oh, okay. A fair game.
Yeah, so essentially it's saying you can't develop a trading system based on publicly available information that will consistently beat the market.
Okay, so like no magic formula.
Right. If everyone has access to the same information, any predictable advantage should disappear pretty quickly.
So what about all those day traders out there, glued to their screens, convinced they found some secret pattern?
Right. They're convinced they've cracked the code. Well, the paper talks about this idea of random walks, which suggests that stock price changes are kind of unpredictable, like flipping a coin.
Oh, so there's no way to predict where it's going to go next.
Now, the pure random walk model might be a little too extreme, but a lot of the research that Fama reviews in this paper supports the idea that predicting short-term price movements is incredibly difficult.
Okay, so even if you think you see a pattern,
Yeah.
it's not really going to help you.
Well, even if you do spot a pattern, you got to remember, trading costs will likely eat up any potential profits.
So much for getting rich quick.
Right. So it's not as simple as just seeing a pattern, then boom, you're a millionaire.
Right.
One of the interesting things that Fama looks at in this paper is a study about stock splits.
Stock splits.
When a company increases the number of shares, but the total value of the company stays the same.
Yeah, like cutting a pizza into more slices.
Exactly. You still have the same amount of pizza.
Right.
But here's the interesting thing. The study found that stock prices actually tend to rise before a split is announced.
Wait, so it's not the split itself that's driving the price up?
Not necessarily the split itself.
That's really counterintuitive.
It is. And the researchers believe that this is because stock splits often signal a future dividend increase.
Okay.
So it's almost as if the market is anticipating that increase and pushing the price up before the news is even officially announced.
So the market's kind of predicting the future.
In a way, yeah, it's pretty fascinating.
So that is fascinating. So the market's not just reacting, it's kind of anticipating what's going to happen.
Yeah, it suggests a certain level of efficiency that maybe we wouldn't expect.
That's pretty wild. And the paper, goes into other examples of this too. Like there's a study that shows that when companies make earnings announcements prices react almost instantly to this public information.
Yeah, I mean, think about it. By the time you read about a company's amazing earnings in the newspaper,
Yeah.
it's probably already too late to profit from it.
The market has already factored it in.
Exactly.
So are we saying it's impossible to beat the market?
Well, that's a big question.
What about, insider information?
Ah, yes, the classic insider trading dilemma.
Right.
So this is where the idea of strong-form market efficiency comes in.
Okay.
And realistically, we wouldn't expect it to hold perfectly. I mean, people with privileged information might have a temporary advantage.
So like, a corporate executive who knows that their company is about to be acquired.
Right, exactly.
Yeah.
But even then, studies show that while insiders might profit from this knowledge, the market catches on pretty quickly.
So you can't really exploit this for very long.
Exactly. It's not a sustainable strategy.
Okay, so what about like professional investors? They have these huge teams of analysts and they have access to all this data. Can they beat the market consistently?
Well, that's another great question. And this paper actually reviews some research by Jensen on mutual fund performance.
Okay, mutual funds.
Yeah, and he used a model to adjust for risk. So we're comparing apples to apples here.
So a level playing field.
Exactly. And what he found was pretty striking.
What did he find?
He found that most mutual funds actually don't outperform the market.
Wow.
And that's before fees.
So even before they take their cut.
Exactly. So
Yeah.
think about what that means for the average investor.
So you're saying most people would be better off just investing in like a diversified portfolio of stocks themselves?
It really makes you think about those high mutual fund fees, doesn't it?
It does.
And all that research they claim to be doing?
Right. So are you saying we should just give up and pick stocks randomly?
Not at all.
Okay.
Fama's work doesn't say we should abandon research altogether.
Wow.
It's more nuanced than that.
Okay.
Markets might be generally efficient, but they're not perfect.
So there's still room for smart investing.
Absolutely. Think of the market like a giant puzzle.
Okay, a puzzle.
Yeah, and the pieces are constantly changing and new ones are added all the time.
Right.
The market being efficient puts that puzzle together pretty quickly.
Okay, but a puzzle with constantly shifting pieces, that sounds pretty impossible to solve.
Exactly. That's why it's so tough to beat the market consistently.
Okay, so you're not just trying to outsmart a few other traders, you're going up against the collective knowledge of the entire market.
Precisely.
That's intimidating.
It is, and all those studies that Fama reviewed, the ones on stock splits and earnings announcements, even mutual fund performance, they all point towards this surprising efficiency.
So we've established that markets are efficient at least most of the time.
It seems that way.
But if that's true, why do we see so much trading?
Yeah.
Why are people still trying to beat the market? I mean, if everyone believed prices were accurate, wouldn't trading volume drop to almost nothing?
You've hit upon a central paradox.
Okay.
If everyone believed markets were perfectly efficient, no one would bother to trade.
So why are we all glued to our brokerage accounts?
Well, human behavior isn't always perfectly rational, right?
Right.
We're driven by emotions, by biases, sometimes a bit of overconfidence.
So even with all that evidence, a lot of investors still think they can outsmart the market.
Yeah, they might cling to certain trading strategies, chase hot stocks, try to time the market even when the odds are stacked against them.
And let's not forget about those professional money managers.
Oh, yeah.
I mean, they have a vested interest in convincing us that they have special skills that can generate superior returns.
It's true. If everyone just invested in low-cost index funds, a lot of those highly paid portfolio managers would be out of a job.
Right.
But it's not just about overconfidence or industry incentives. Trading volume can also be driven by differences in risk tolerance, investment horizons, even just plain old liquidity needs.
Right. Someone might sell stocks just because they need cash for a down payment on a house, not because they think the market's about to crash.
Exactly.
Okay.
And some people are willing to take on more risk for the potential of higher returns, even if it means deviating from the most efficient portfolio.
Okay, so the real world is a bit more complex than these elegant theoretical models.
It always is.
Yeah. Human behavior adds a layer of complexity to financial markets. But even with all that complexity of Fama's work on efficient capital markets, it gives us like a really valuable framework for understanding how markets really work.
It does. It provides a really solid foundation.
Yeah, and it reminds us that, prices usually reflect the collective wisdom of the crowd.
The wisdom of the crowd.
Yeah, and trying to outsmart that crowd.
Yeah.
That's a really tough game.
It is much tougher than most people think.
Yeah. So should we all just surrender to the market then and just stop trying to pick stocks?
Well, not necessarily. I don't think that's the message here.
Okay.
But we need to be realistic about our chances.
Okay.
Remember, in a truly efficient market, the only way to get higher returns is to take on more risk.
So there's no free lunch.
Exactly.
Okay, that's a key point. And it leads us to a pretty crucial question. I think if markets are so efficient at processing information, why do we still see so much volatility?
Volatility, the age-old mystery.
Right. Why do markets seem to overreact to certain events or even ignore others?
That's a question that's puzzled economists for decades.
And Fama himself
Oh, yeah.
grappled with this in his later work.
He spent a lot of time thinking about these anomalies.
And this is where things get really interesting.
They do, because even though markets are generally good at incorporating information,
Yeah.
they're not perfect information processing machines.
Okay.
There are limits to how much information can be absorbed at once.
So there are times when the market might actually misprice assets.
It's possible, even if everyone is acting rationally.
Okay. That's interesting.
Think about it. The market is made up of millions of individuals, each with their own unique perspective, biases, and limitations.
Right.
Even if everyone has access to the same information, they might interpret it differently or react to it at different speeds.
And sometimes important information might be hidden or just difficult to interpret.
Exactly.
Even for the most sophisticated investors.
Absolutely.
And let's not forget about emotions.
Oh, emotions always play a role.
Right. Fear and greed.
Yeah,
Those can really drive prices up or down.
absolutely, even in the absence of any new fundamental information.
We've all seen those market bubbles and crashes.
Oh, yeah, those are prime examples of how emotions can distort prices.
Yeah, and create temporary inefficiencies.
Right. So while the efficient market hypothesis provides a really powerful framework,
Yeah.
it's important to remember it's not a perfect description of reality.
Right. Markets are complex.
They are
Dynamic system.
always evolving.
Yeah, and there are always going to be factors that we can't fully explain or predict.
And that's what makes them so fascinating to study.
I completely agree. This deep dive has really challenged my assumptions about how markets work.
It's been a good one.
It has. So if markets aren't perfectly efficient, what does that mean for the average investor? How can we make smart decisions in a world where information is constantly changing and prices can be influenced by these unpredictable factors?
Those are great questions, and they lead us to some really practical advice for navigating this complex landscape.
Okay, I'm ready.
First, it's essential to understand the limitations of market timing.
Okay.
Trying to predict short-term price movements is a losing game.
So we should avoid chasing those hot stocks that everyone is talking about.
Exactly. Instead, focus on building a diversified portfolio that aligns with your long-term goals and your risk tolerance.
So slow and steady wins the race.
You got it. Time in the market is more important than time in the market.
Okay, that's sage advice.
Yeah.
What else? Any other pearls of wisdom?
Well, it's also crucial to do your research and understand the fundamentals of the companies you're investing in.
So don't just buy a stock because someone on social media told you to.
Right. Look beyond the hype and focus on factors like earnings, revenue growth, debt levels, and management quality.
Okay.
These are the factors that drive long-term value.
So do your homework, avoid the hype. What else?
And remember, even in a generally efficient market, there will always be opportunities for those who are willing to dig deeper and think differently.
Okay.
Don't be afraid to challenge conventional wisdom and look for undervalued assets that others might be overlooking.
So you're advocating for like a balance between respecting market efficiency,
Yeah.
but still being an active, engaged investor.
Exactly. It's not about being passive or blindly following the crowd.
Okay.
It's about being informed, discerning, and having a long-term perspective.
Makes sense. But this idea of market efficiency, it can feel pretty intimidating.
I understand.
If markets are so good at incorporating information, does that mean individual investors are just powerless pawns in this giant game?
That's a common concern, but I think it's important to remember that even in an efficient market, individuals still have a role to play.
Okay.
Your decisions collectively shape the market.
So we're not just along for the ride.
Absolutely not. Your investment choices, based on your individual goals and risk tolerance, they contribute to the overall efficiency of the market.
So we're all part of this giant ecosystem.
We are. And remember, even in a generally efficient market, there will always be room for those who are willing to think independently, do their research, and take calculated risks.
Okay, so don't be discouraged by the idea of market efficiency. Embrace it
Embrace.
as a challenge and use it to your advantage. I love that perspective. This conversation has been incredibly insightful. We've explored the core concepts of market efficiency, delved into its implications, and even tackled some of the paradoxes and challenges that it presents.
And we still got more to uncover.
We sure do. Stay with us. We'll be right back after a quick break.
Sounds good.
Welcome back. Before the break, we were talking about how markets might not be perfectly efficient after all.
Yeah, there's always more to the story, right?
Right. But in this paper, Fama also gets into some pretty complex stuff.
Oh, yeah, he goes deep.
He talks about how stock price changes are distributed.
Like statistically.
Yeah, whether they follow a normal distribution or something else.
Right. The classic bell curve.
Exactly.
Most changes clustered around the average.
Yeah, fewer and fewer as you move further away from the center.
But some economists argue that real-world stock price changes are wilder than that.
They are right. Like sometimes prices jump or plummet way more than you'd expect.
Exactly, those big market swings.
Huge swings.
They called those extreme events fat tails.
Okay, fat tails.
Yeah. To account for them, they suggested that stock price changes might actually follow a different kind of distribution.
Not the normal one.
Right, something called a stable distribution.
Okay.
It's a family of distributions that includes the normal distribution, but it allows for more of those extreme moves.
So the normal distribution is like a well-behaved guest at a party.
I like that.
And these stable distributions might spike the punch bowl every now and then.
Exactly. Now, economists have been a bit hesitant to fully embrace these stable distributions because they can be tricky to work with mathematically.
I see.
But Fama's research helped to shed light on them and develop methods for analyzing them.
So it's not just a theoretical debate.
No, it has real-world implications.
Because if stock price changes are more prone to those extreme movements,
Yeah.
our traditional risk models might be underestimating the true riskiness of some investments.
That's a really important point.
Especially for anyone managing a portfolio. From professional investors to everyday people saving for retirement.
It really underscores the importance of not blindly relying on assumptions.
Right.
And constantly questioning the tools we use in finance.
Wow. So this seemingly technical discussion about statistical distributions actually has huge consequences.
It does. It all comes back to this idea of understanding how markets work.
Yeah.
And how we can make better decisions as investors.
Okay, so this deep dive has really been an eye-opener. We've gone from the basic idea of efficient capital markets to the nitty-gritty details of statistical distributions.
We've covered a lot of ground.
What's the key takeaway for our listeners?
Well, I think the big takeaway is that markets are surprisingly good at processing information and reflecting it in prices.
Even if they're not perfect.
Exactly.
And it's a reminder that trying to outsmart the market is a really tough game.
You're up against a lot of smart people.
And a lot of information.
That's right.
So it highlights the importance of a disciplined, long-term approach to investing.
Well,
don't get caught up in the hype or chase short-term gains.
Slow and steady wins the race.
Do your research, build a diversified portfolio, and understand your own risk tolerance.
Those are the keys to success.
And remember, even with all this talk about market efficiency, there's still a role for individual investors.
That's an important point.
We're not just cogs in a machine.
Right. Your decisions collectively shape the market.
And even in an efficient market, there will always be opportunities for those who are willing to think independently, do their homework, and take calculated risks.
So don't be discouraged by the idea of market efficiency. Embrace it as a challenge and use it to your advantage.
I love that perspective. This conversation has been incredibly insightful. We've explored the core concepts of market efficiency, delved into its implications, and even tackled some of the paradoxes and challenges it presents.
Yeah, it's a fascinating topic.
Welcome back. Before the break, we were talking about how markets might not be perfectly efficient after all. But in this paper, Fama also gets into some pretty complex stuff, right? He talks about how stock price changes are distributed, like whether they follow a normal distribution or something else entirely.
Yeah, he dives into this debate about whether stock price changes fit that classic bell curve, the normal distribution.
So imagine a graph where most changes are clustered around the average with fewer and fewer changes as you move further away from the center.
Right, exactly.
But some economists, like Mandelbrot, argued that real-world stock price changes are wilder than that.
Yeah, they're not always so well behaved.
Right. They pointed to those times when prices jump or plummet way more than a normal distribution would predict, like those big market swings.
Yeah, those huge swings that seem to come out of nowhere.
Right.
They call those extreme events fat tails.
Fat tails, okay.
Yeah. And to account for them, they suggested that stock price changes might actually follow a stable distribution instead.
Instead of the normal one.
Right. It's a family of distributions that actually includes the normal distribution, but it allows for more of those extreme moves.
So the normal distribution is like a well-behaved guest at a party.
I like that.
And these stable distributions, they might spike the punch bowl every now and then.
Exactly. Now, economists have been a bit hesitant to fully embrace these stable distributions because they could be tricky to work with mathematically.
Ah, I see.
But Fama's research helped to shed some light on them and develop some methods for analyzing them.
So it's not just a theoretical debate, it has real-world implications.
Absolutely.
Because if stock price changes are more prone to those extreme movements,
Right.
then our traditional rich models, they might be underestimating the true riskiness of some investments.
Yeah, which is a big deal for anyone managing a portfolio.
Huge, from professional investors to just everyday people saving for retirement.
Right. It really underscores the importance of not blindly relying on assumptions
Yeah.
and constantly questioning the tools that we use in finance.
Wow, so this seemingly technical discussion about statistical distributions actually has huge consequences.
It does. It all comes back to this idea of understanding how markets work
Yeah.
and how we can make better decisions as investors.
This deep dive has really been an eye-opener. We've gone from this basic idea of efficient capital markets to the nitty-gritty details of statistical distributions.
It's been a wild ride.
It has. What's the key takeaway for our listeners?
Well, I think the big takeaway is that markets are surprisingly good at processing information and reflecting it in prices.
Even if they're not perfect.
Exactly, yeah.
And it's a reminder that trying to outsmart the market is a really tough game.
It's not easy, that's for sure.
So it highlights the importance of a disciplined, long-term approach to investing.
Absolutely.
Don't get caught up in the hype or chase short-term gains.
Slow and steady wins the race.
Do your research, build a diversified portfolio, and understand your own risk tolerance.
Those are the keys to success.
And remember, even with all this talk about market efficiency, there's still a role for individual investors.
That's an important point to remember.
We're not just cogs in a machine.
Right. Your decisions collectively shape the market. And even in an efficient market, there will always be opportunities for those who are willing to think independently, do their homework, and take calculated risks.
So don't be discouraged by the idea of market efficiency. Embrace it as a challenge and use it to your advantage.
I love that. That's a great way to put it.
I think Fama would be proud. So as we wrap up this deep dive, we want to leave you with a question to ponder. If markets are indeed as efficient as Fama suggests, why do we still see so much active trading and attempts to beat the market? Is it irrationality, overconfidence, or are there other forces at play? That's for you to decide. We encourage you to keep exploring the fascinating world of finance and to approach the market with a healthy dose of skepticism and critical thinking.
And remember, like the market itself, learning about finance is a journey without a finish line.
Thanks for joining us on this deep dive. Until next time, stay curious.